Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call, Tuesday morning. And I think Monday has been an absolutely amazing day. US markets have responded, in a similar kind of way that we did yesterday, or even better. So lots to talk about, lots to discuss. Overnight news flow as well. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Surabhi and Nigel. Guys, good morning.
Hi, morning, folks. Yesterday was a spectacular blockbuster, right? But this morning, I think the question is whether Asia, had much of the hurrah just yesterday, or whether there's any follow-through action. And I think right now we're getting slightly mixed signals, but yeah, big moves in the US overnight, Nigel.
Well, since the globe is a better place, and I just wanted to focus on the climate today. It looks like it's going to be a bit of a rainy day here in Mumbai. Dark clouds up above. It's been a while. It's the month of May. Looks like the rains are going to be here early.
By the way, the IMD is saying that the rains are going to hit Kerala, the coast of Kerala. 1st of June is the date.
27th, right? I think
27th of May. So it's
27th
early.
of May.
So plus minus 4 days. So
for all the Mumbai mayhem during the monsoons, I must put on record, that's the season I love. Really looking forward to the Mumbai monsoon.
And the normal monsoon is something the market looks forward to, besides Surabhi looking forward to. So that's good news, another tailwind for us. But let's get straight to the action, Prashant.
Absolutely. Let's just quickly take it from the top and tell you what you need to know as we begin this new session. So US-China tariff reductions are a game changer. At least from a tactical point of view, it is a game changer. There is no two ways. There is no question about it. I'll get to what markets did, but I'll tell you how much the view has to be changed, right? I mean, everything that equity analysts and economists, etc., have written for the last since the 2nd of April, I mean, they got to write it again with different assumptions. So it's a flux, but in a positive way for once, at least this year. So Goldman Sachs is making 3 changes. They're saying growth forecast for the US is back to 1%. For that is 2025. Recession risk, they're cutting down to 35%. And rate cuts, they're pushed out to December. Obviously because they don't expect a very sharp deterioration as far as US growth is concerned. And this is what I'm saying. This is just one house, and we'll get you more as we go along. Equities last night zoomed. S&P was up 3%. The Nasdaq was up 4%. The Russell was up 3.5%. I mean, we saw a 3% plus move on the Nifty yesterday as well. So these are perfectly in line with what we saw here. The S&P 500 broke above its 100-day moving average. It's also above its 200-day moving average. Now, it's reclaimed 200-day moving average for the first time since March. Wix fell a sharp, I think, 16% or so. It's back under 20, closer to about 18.25. The 10-year yield, it's risk on. I mean, yields went up 9 basis points, 4.5% nearly. The dollar, actually, if there is one thing, there are 2 things which feel out of sync with this changed environment. One is the US dollar. So you've got to ask the question whether the dollar has got broad upside from here, because people have been short dollar in a big way. The dollar index last night was up. And the other thing which is just kind of felt out of sync, even before the announcement of the US-China, cooling it, has been equities were bouncing in any case, and oil fell out of sync, falling to 60, etc. So oil yesterday was up about 2% or so, $65 or so on oil prices. Now, in terms of Trump, he focused on he spoke about the pharmaceutical price fairness. There was a press conference. We'll probably play sound bites from that. The EU, European Union, was criticized the most. Remember, pharma has been the focus here as well. Even with a 3% gain on the Nifty, there was the pharma index which was down. And, some of the stocks, of course, were down in a pronounced way. Geopolitical headlines: Trump is going to be traveling for 3 days, 13th to the 16th, to Saudi Arabia, Qatar, United Arab Emirates, the UAE. And I think this is essentially a trip to lock in some of the investments these countries have promised to make onshore in the US. We'll put out the data with Nigel in terms of how much short covering, etc. we saw. But my sense is a lot of what we saw, at least in the first half, was short covering. But that does not mean that real cash buying can't lead to overshoots from here on the way up. So be mindful of that. Nifty closed yesterday above the previous high. The psychological resistance immediately up next is 25,000, around 25,000 number. And after that, I mean, the 78.6%, 61.8 is gone, 66 is gone. I mean, you will stretch it, 25,310 is a 78.6% retracement of the entire decline the Nifty has fallen, has seen. And support comes in at the 20-day moving average. It's far away, but basically that's because we got a 4% pop yesterday. 24,027 is the 20-day moving average for the Nifty as of yesterday's close. Nifty Bank, it can retest the recent high, I mean, to begin with, 56,098 and then 56,450. And on the way down, the Bank Nifty support stands at the 20-day moving average, which is 54,269. So, GIFT Nifty, I think, is indicating a slightly lower start, a 100-point cut. And that perhaps is natural because we got a 4%, I mean, 3.5% pop on the benchmark index. So, in all fairness, it's perfectly reasonable to expect maybe a little bit of a drawdown. But I would still emphasize, just in terms of sheer the surprise, what has happened after the weekend and the announcement yesterday. I mean, tactically, I mean, it is risk on as far as many asset classes are concerned. So 24,921 on the GIFT Nifty. Surabhi.
Absolutely. By the way, speaking of Trump's trip to the Middle East, I don't know if you guys got that point. The latest conflict is what? Plane.
Plane, sorry.
It's the plane, it's not the car. $400 million, 747, Boeing 747. He's willing to take it as a gift from the Qataris. And there's a huge furor back in the US about the proprietary or the impropriety of such a gift. But anyway, that's Mr. Trump for you. Now let's talk about some of the other cues as well. So the good news, the great news actually, is that we had another night of, largely a night of calm across our borders. So no, untoward instances being reported. Yesterday, the DGMO level talks happened. Apparently, the Pakistani side tried to raise the Indus Water Treaty issue, but India kind of completely negated that and did not entertain any of those discussions at all. It was strictly a military conversation. The watch point from here on, when it comes to geopolitics and macros for us here in the subcontinent, I feel, is really going to be the Indo-US relationship and the posturing that the US has taken in the last 3-4 days on this entire conflict. We have some instances of that, and I'd very carefully watch out for the progress on the Indo-US trade deal from here on. And this morning, we had a fresh development. India has gone to the WTO, the World Trade Organization, and it has proposed retaliatory duties against US steel and aluminum tariffs. Remember the higher tariffs that the US had levied? So we've gone to the WTO to protest that. Now, is this a first? Are these just going to be diplomatic skirmishes or something more? What happens to the India-US trade deal? Let's see. Yesterday, obviously, we had more statements coming in from Donald Trump, and I'm just reading out the sheer gist of it. He's claiming that this is a US, stopped a nuclear conflict, and it would have otherwise been a bad nuclear war. And not just that, he's saying that I told both India and Pakistan that we can do a lot of trade with both the nations, but only if they stop the military action. So we need to see how the Indian side is going to respond to that. We heard the Prime Minister's address to the nation yesterday. Absolutely no mention of the US or any other, international player in this. And in fact, he said that we will not, give in to nuclear blackmail. So very strong statements. Watch the geopolitical space. But coming back to the other market cues, Asia this morning is actually looking quite good. The Hang Seng market is selling off a little bit. So while Japan is carrying on the good run that we had yesterday and this overnight strength on Wall Street, the mainland Chinese markets and the Hang Seng, they're taking it a little easy after yesterday's big rally. The yen, by the way, is a watch point. Remember the big move on the dollar yesterday? The yen had weakened to as low as 148.4, 148.5. So from those levels, is a bit of a relief pullback, some strength on the yen that's coming through. Now let's talk about our markets. What a blockbuster Monday we had. The highest percentage gain in the last 4 years since Feb 21. That's what we saw yesterday. It was a bazooka day. The Nifty is up almost 15% from the April low. That low was made on the 7th of April. And from that point onwards, it's been a stunning recovery, 14.6% to be more precise. And now we're just 5% away from the all-time high. So is taking the all-time high out a given? Let's see. We'll track this as we go. Flows, the FPIs are back to being buyers yesterday, but it is not a very big buy figure to tie in with what Prashant said. Yesterday, even domestic institutions were buyers, but you can see the numbers, 1,200 crores, 14 to 1,500 crores. It's not like we had 8,000 crores of buying coming through. So that's why the F&O market analysis will be very important, and we'll get to that in just a bit. A couple of stocks in focus today. There are a couple of block deals that Nimesh has been alerting us on. So watch out for Paytm Antfin could be selling some stake. There's KFin Tech, where General Atlantic Singapore, they could be looking at selling some stakes. So block action is back. And of course, we'll react to more numbers, fag end of the earnings season. Tata Steel's come in. Nigel's been telling us numbers are more or less in line. So we'll get more details in a bit. But largely watching out for a stable session, perhaps. Nigel.
Well, the Indian markets, we're running a big marathon. And yesterday's trading session, we had a 100-meter sprint. And we aced that. So I think maybe today, maybe for a couple of trading sessions, a bit of pause, getting your breath back may not be such a bad idea. And it seems that could be the case after the big, quick 100-meter sprint that we saw yesterday. Well, the close was very, very strong. And the last tick of the day was at the day's high. However, overnight cues, if you look at the Troika, that's the yields, the dollar index, as well as Brent crude prices, all of them a little bit higher. Brent crude prices more or less flattish overnight, but the other two as well did gain some strength. And the Troika, well, not really in favor of the Indian markets. We like, softer data coming out from all of them. Moving to the traded value yesterday, the NSE traded value was much higher than what we saw in Friday's trading session, which tells you in Friday's trading session, we saw profit taking actually on rather low volumes. But given the kind of volume that you saw yesterday, you would have liked to see an institutional net buy number that was more than 2,500, 2,600 crores. Then who drove up the markets yesterday? In all likelihood, it could be retail audience and large HNIs that were sitting on the sidelines. They came in there and they deployed the money, which explains why we saw very, very solid market breadth even in yesterday's trade. What about the index futures? Well, the FIs, they bought close to around 1,200 crores in the cash market. But on index futures, there was some mild short covering that we saw 7,000 contract, swing out there because 4,000 contracts were covered out on the short side and 3,000 contracts were added on the long side. On stock futures as well, there was short covering. Close to around 30,000 contracts did close out. And you had close to around 78,000 contracts that were added. So clearly, there was some short covering that did take place. What about the options data? Well, the FIs, they bought more puts than calls in yesterday's trading session. But the good news is they continue to write higher amount of puts in comparison to the number of calls. And that is the important data point. 1.5 lakh puts written yesterday. That compares with around 40,000 calls, which is telling you the base of the market is likely to have moved up a little bit. Because of the aggressive put writing that we've seen, the PCR has now jumped up to around 1.3. Normally at around 1.5, we do see the markets come in for some bit of profit taking, some kind of consolidation. So the PCR as well has jumped up a large deal. And pull up a couple of strikes. In yesterday's trade, 24,500 put, 24,600 put. Both of them, added close to around 1.3 crore shares between these two. And then it appears if the markets just take off, some out-of-the-money call buying is what we saw in yesterday's trade. All you lose is 30 rupees. So it appears a bit of a punt taking place out there. Which brings us to the levels. Since the GIFT Nifty suggesting a bit of a pullback, 150-point pullback to kickstart trade, well, I think, the crucial support zone needs to be maintained. This 24,550, 24,600. The markets are in an uptrend. It has moved to a buy on dips market. Some kind of near-term consolidation is what we could look at. But the band that was a bit of a resistance on the upside, that's going to be the crucial support and the near-term support. The Nifty Bank, the next leg of this uptick starts once the Nifty Bank can conquer that 56,000 mark. Because in the last month or so, we have visited this level numerous times, but we couldn't continue that. So that's why, in fact, that's the important mark, 56,000 on the Nifty Bank. If it can conquer that, then the next leg of the up move starts, both for the Nifty as well as the Nifty Bank. I'll keep an eye out on the broader markets as well, because yesterday the breadth of the market was spectacular. So some kind of cooling off, some kind of consolidation in the near term, par for the course for the Nifty.
Absolutely. Given that, steroids move that we've had 15% in just about a month, perhaps some sort of consolidation would be indeed par for the course. Let's get you the equity call of the morning. Chetan Chetha for Nomura says the US-China agreement on Monday, where tariffs were reduced, came as a significant surprise for markets and will likely support risk positivity in the near term. He says there is China equities to a tactical overweight. He adds that they're staying overweight on India, but trim the overweight to fund the China upgrade. For now, he says they're adding 1 percentage point overweight to China equities by reducing allocation to India equities by 1 percentage point. Very, very interesting. So is it advantage China? Just from a tactical point now, well, for Nomura, it seems to be.
Well, this is Venugopal Gare of Bernstein, who believes that markets are positioned well. He says macro picture will stay resilient with improved liquidity, lower rates, better government capex spends, rural demand, and support from tax cuts helping reduce earnings risks. He expects volatility to continue. Do not expect a linear increase in the Nifty, but he reiterates their end-of-the-year target at 26,500 and suggests bottom-up stock picking. Lynn Alden is founder at Lynn Alden Investment Strategy, and she's joining us now to take some questions. Lynn, good to have you with us here. Thank you very much. Is this a bit of a game changer from a tactical perspective for markets, what we've seen between US and China, Lynn, on the way up in terms of risk on? What's your sense?
So certainly, tariffs were the biggest weight on global markets. And so with a significant release from that, that allowed obviously markets to rally today. And as long as there's no re-escalation, this is pretty constructive. I'm bullish on Chinese equities here. And broadly, ex-US equities are pretty attractive. Financials globally are pretty attractive. I still think there's some weight for the rest of the year to some extent on US equities and markets because the tariff rates are still pretty significant and there's still considerable uncertainty. But this is certainly a welcome development compared to how we were last week and the week before.
Lynn, hi, great to have you on. Okay, take your point. It is a welcome development for sure. And it did catch the market by surprise. I think the extent of the rollback from 145% to now 30% tariff on China. Does this give enough ammunition to the market, US equities or even Chinese equities for that matter, to look at a fresh leg up?
I think there's a good chance it does. The prior tariff rates were essentially an embargo. When kind of analyzing different companies, say throughout the U.S. that import Chinese products, many of them were in complete standstill. They had little idea of how they were going to operate in the coming weeks and months when you're at literally over 100% tariffs. And when you're looking more at 30% tariffs, well, that's still a major burden. Businesses can find ways to operate around that. So that gets at least back to normal business functioning and allows probably Chinese volumes to be decent. And it's more of a margin issue on U.S. corporations and U.S. consumers. So I think this at least puts us back into there's a clear way forward here, even though there are still some weights, particularly on, for example, U.S. corporate margins and therefore, 12-month stock market potential.
All right. Hi, Lynn. Good morning. Good to see you. Lynn, so what's the preference? You're bullish on Chinese equities, as you just said. But between developed markets and emerging markets, what's the preference out there? And where does India come? Because we have had a good run. But if you're bullish on Chinese equities, then where does India stand? Please go ahead.
Yeah, so I have a preference overall for emerging markets to developed markets here. One exception maybe is financials. I like them both in developed and developing countries. But in terms of broad equities, I think emerging is more attractive here. While India is attractive, it had a nice run recently. And overall, there's still decent news priced into it compared to some other markets. I think China is still kind of unusually inexpensive. So it's mostly a valuation play in that sense. And I would put Brazil in a similar bucket. So they're more value plays. So I'm a little bit more tactically bullish on those. But I think broadly, Asia in general, parts of South America, pretty strongly positioned right now. And even if these tariff issues do re-escalate at some point, Asia in general, multiple countries have very strong negotiating positions. We saw, for example, the Association of Southeast Asian Nations last week came out with a pretty strongly worded joint statement, along with some of their partners, China, South Korea, and Japan, reconfirming their commitment to global trade, particularly between themselves as well. And so I think overall Asia is very strongly positioned, both tactically and structurally.
But Chinese equities over Indian equities at this juncture, given the valuations, is that correct?
Moderately, yes, but I like both. Between the two, I would err toward China at the moment.
And guys, Chinese exports should be red hot, right? Because, you got this 90-day pause. Who knows what will happen after 90 days?
But now for 90 days, only 30%.
Imagine if you're a Walmart, you'd buy
stock up.
Christmas supplies for 2025 and 2026. Right? So, I think it's going to be a big push out, which we will see. Lynn, thank you very much for joining us and running us through all of that. Appreciate your time here on CNBC-TV18. Sorry.
And I just wanted to reiterate Lynn's view, and before that we had Chetan Sheth from Nomura, and I think we have to take this on board. And this was always going to be a risk that whenever there's a thaw between US and China, just because Chinese equities are so cheap, tactically, you would want to spread a bit, and we've rallied 15%. So I think those tactical moves we need to be kind of a little cognizant of, at least in the near to short term.
No, 100%. Well, let's just quickly get you the top story from yesterday evening as well. Prime Minister Narendra Modi addressed the nation, took a strong stance in his first address since Operation Sindoor began. PM Modi delivered a strong message not only to Pakistan but also to the world. Let's listen into the key comments Prime Minister Modi made on how India plans to deal with the encroaching terrorism from Pakistan from here.
अगर पाकिस्तान से बात होगी तो टेररिज्म पर ही होगी। अगर पाकिस्तान से बात होगी तो पाक ऑक्युपाइड कश्मीर पीओके उस पर ही होगी। प्रिय देशवासियों, आज बुद्ध पूर्णिमा है। भगवान बुद्ध ने हमें शांति का रास्ता दिखाया है। शांति का मार्ग भी शक्ति से होकर जाता है। पाकिस्तान को अगर बचना है तो उसे अपने टेरर इंफ्रास्ट्रक्चर का सफाया करना ही होगा। इसके अलावा शांति का कोई रास्ता नहीं है। भारत का मत एकदम स्पष्ट है। टेरर और टॉप एक साथ नहीं हो सकते। टेरर और ट्रेड एक साथ नहीं चल सकते। और पानी और खून भी एक साथ नहीं बह सकता। हमने पाकिस्तान के आतंकी और सैन्य ठिकानों पर अपनी जवाबी कार्रवाई को अभी सिर्फ स्थगित किया है। आने वाले दिनों में हम पाकिस्तान के हर कदम को इस कसौटी पर मापेंगे। अब ऑपरेशन सिंदूर आतंक के खिलाफ भारत की नीति है। ऑपरेशन सिंदूर ने आतंक के खिलाफ लड़ाई में एक नई लकीर खींच दी है। एक नया पैमाना, न्यू नॉर्मल तय कर दिया है। पहला, भारत पर आतंकी हमला हुआ तो मुंह तोड़ जवाब दिया जाएगा। दूसरा, कोई भी न्यूक्लियर ब्लैकमेल भारत नहीं सहेगा।
Okay, well, that was the Prime Minister yesterday in that strong message to the nation. Well, let's tell you about the interactions that are lined up on the show today. At 8:35, we'll have the management of Kim's Hospital joining in to talk about their Q4 earnings and the outlook. At 9, Param Desai of PL Capital and Anaswamy Vedesh, former MD at GSK Pharma, joins in to talk about this executive order when it comes to US drug prices. So what does that mean for Indian generic companies? We'll find out. At 9:20, we have Shreyash Devilkar of Axis Mutual Fund joining in. He's a market master of the day. At 9:30, we'll be in conversation with the management of Aether Energy, talk about their fourth quarter numbers. After that, Aditya Saraugi of Birla Corporation joins in. Of course, Birla Corp, you remember the numbers for fourth quarter were very, very strong. We'll discuss the outlook. At about 9:50, we will have Venkatraman Narayan and Joseph Anantaraju of Happiest Minds Technologies to talk about how Happiest Minds fared in the fourth quarter. Towards the end of the show, in our special segment, it's the economy. Lata speaks with economist Andrew Tilton about the impact of the spate of trade deals by US with China and UK.
Time to slip into a short break. A lot of stock-specific action to track. We're going to be focusing on our special top 10 segment. The stocks we're running through: Hindalco, we have Pharma stocks, Tata Steel, Chalet Hotels, Ventive Hospitality, Kim's, and Pyramid Pharma. All of them will be reacting to positive news flow. On the flip side, Happiest Minds, Paytm, and KFinTech will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
Welcome back. So we're watching out for a slightly more cautious start as far as Indian trade is concerned. The implied open has been telling us that we could be starting about 100 points or so lower Asian markets are mixed, 128. Let's just pull up the Hang Seng index as well, because the Hang Seng is cooling off after yesterday. I mean, even the Hang Seng was up 4%. So a bit of a pullback in that market as well. But others like Taiwan, you can see, Japan, they're still positive. Now, what about individual stocks? So let's straight away get to the CNBC-TV18 list of top stocks to watch. Starting first with what else but Tata Steel. Nigel, how were the numbers?
Well, Tata Steel's numbers actually were more or less in line with what the street was working with. If you compare the numbers, the revenue, the EBITDA number, the margin's a little bit better as well out there. But for Tata Steel, we normally look at the EBITDA per ton for both the geographies. That is for India as well as Europe. And those were bang in line with what we were working with. So India was at around 12,700 rupees on a per ton basis, while Europe was at a negative $37 per ton. So more or less in line on a per ton basis. Netherlands, they managed to eke out some gains out there because things are stabilizing, while you have the UK operations that continue to drag. The positive is that because of the release of working capital, you had the net debt that's come down. And over the last 2 quarters, actually, it's come down from around 88,000 crores. It's come down to around 82,500 crores or thereabouts. They've also given a bit of a sweetener. They're giving close to around 3.6 rupees of dividend. And they'll be investing close to $2.5 billion to fund the UK capex. That's more or less in the price. I'm going with green out here because these numbers are in line with what the street was working with. The outlook is better because now we have the safeguard duty and, we've seen a bit of a perk up in terms of pricing. So that is good. And they're also guiding for cost savings of around 11,500 crore rupees for the coming year. I'll speak to the management later today, but going with green on this one.
You had a really busy last 12 hours, Nigel. So let's quickly also talk about Hindalco because Novelis's numbers came. So what's the read-through?
What tells you I don't normally have busy evenings,
Okay, extra busy evening.
Normally on the ball, yeah. But anyway, since it's my home sector, yeah, Hindalco's in focus because Novelis came out with its set of numbers. And those numbers were actually good. As they had guided us that Q4 will be better, Q3 was an absolute washout. So the volume number came in at around 950,000 tons. On a year-on-year basis, not too much of a movement. But on a sequential basis, remember Q3 you have Christmas and the holidays in the western part of the world. So it was up by close to 5 to around 6%. Net sales, adjusted EBITDA and the EBITDA per ton, that came in at around $494 on a per ton basis. You'll see it's still lower on a year-on-year basis. But that graphic plate tells you the picture because they had said that the Q4 EBITDA per ton will be similar to what we saw in Q2 and bang on. So that improvement is something that the street will like. The net debt number, well, it's not moved too much out there, more or less constant on a quarter-to-quarter basis. The capital expenditure that they've laid out is around $1.9 to $2.2 billion for the next year, which is par for the course. But they're also looking at some savings, in the next few years. However, they have withheld their guidance, which could be seen a bit of a negative because they're expecting geopolitical pressures. The globe is in a bit of a flux, and also the tariffs could weigh on it. And that's why they're saying that they're factoring in $40 million on a quarterly run rate to hit their EBITDA number. That will be a bit of a negative. But since the numbers are more or less in line, well, going with a tinge of green on this particular one. Not giving a guidance, though. That could be on the stock at some point of time. But Pharma, that's been the big headline for the last 24 hours. And Ekta Batra just resumed and she's on the ball. Ekta, tell us, what's the recent developments?
Well, yes, President Trump has signed that executive order to align U.S. drug prices with peer nations. He has mentioned in his executive order that the mechanism to let patients buy drugs directly at the most favored nation prices is something that they are going to execute. Remember that U.S. drug prices are over 3 times higher than in other OECD countries. U.S. funds 75% of the global pharma profits despite being under 5% of the population globally. And Americans subsidize foreign discounts through inflated domestic prices. The impact is that the steps are not as binding as feared. Pfizer, Eli Lilly, Amgen, Sanofi, Novartis, all of these stocks were higher in US trade, giving you an indication of the executive order. There is, as of now, no direct fallout on generic drug pricing, so maybe that would be a relief for Indian pharma stocks. Aims is to basically equalize pricing of patented drugs available in Europe, Canada, which are still cheaper than the US. So they want to equalize that and eventually remove the middleman in the drug pricing scenario in the US. The street will, however, wait to see what the steps would be when it comes to import tariffs on pharmaceuticals. That would be the larger picture to watch out for.
All right, Ekta, when Nigel said on the ball, Ekta, I thought he's talking about paddle or pickle. Which one is it? It's pickle or paddle? All right.
Paddle for sure.
All right. Thanks very much for that. Well, let's talk about Happiest Minds next. Vinny's here with what's happening here. Vinny, good morning.
Hi, good morning. So in terms of Happiest Minds, the Q4 numbers, a slow quarter coming in for the company. So we are expecting a bit of a red coming in on the screens for Happiest Minds. Revenue in terms of dollar terms, very, very flattish. Just 0.3% growth on a sequential basis. CC growth is just at 1.1%. Rupee revenue of around 2.6% on a quarter basis in terms of a growth. Now, overall, when you look at it for FY25, also the CC revenue growth that came in at 25.6%, which is much below the aspiration or the growth target that they had for themselves of around 30%. So, that is why also we could see a bit of a, subduedness that one could watch out for in terms of the stock. EBITDA, when you're looking at it on a calculated basis, 15.4% versus 17.1%, while what the company is reported is at 19.3% versus 21.1%. So Q4 EBITDA margins 19.3%, which the company is saying they've reported, which is lower than the guidance of 20 to 21%, 20 to 22%, which is the guidance that they're given. But for the full year, when you're looking at it, yes, they are in the range of the guidance, but Q4, surely a miss coming in versus the guidance. Wage hikes, senior employees impacted the margins in Q4, as well as PAT also was down by 32% due to exceptional items. So we are expecting red here.
Okay, all right, got that. Thanks very much, Vinny, for that. So Happiest Minds is going to be on the radar. In fact, we're talking to management, like we just told you, about 9:50. The top two from the company join in to give us an outlook ahead. Okay, some more numbers. We have Manglam joining in now. I think he's been looking at Chalet Hotels and also Ventive Hospitality. Manglam, morning.
Well, if there's one certainty over the last few quarters, it is that FMCG volumes are going down and hospitality is continuing to do well. So you have Chalet Hotels, 25% revenue growth, and this is seasonally not even the strongest quarter for the industry. The EBITDA actually jumped by 32%, implying a margin expansion of over 300 basis points, and the net profit surged by 50%. So you're looking at growth coming in from average room rates that have increased by 21% for Chalet Hotels. Occupancy expanded by about 30 basis points, but higher room rates caused the margin expansion for the company and revenue growth. And additionally, they also have, commercial real estate, so new properties coming online, and that actually increased by 75% year on year, and most of that flows through to the EBITDA, and that explains the big move out there. Even Ventive Hospitality, if you look at the reported numbers, they would look very different, but you have to look at the pro forma numbers, and that the company has given on their presentation. It's a 20% jump in their revenue, 717 crores, 23% jump in their EBITDA. That implies a margin improvement of nearly 100 basis points. Here as well, occupancy improved by 5 percentage points and average daily rate increased by 5%. So all these factors leading to a good number coming in for Ventive Hospitality. So these hotels checking in gains.
All right, Manglam, thanks a lot for that. Well, from Manglam, we're tossing it back to Ekta. Ekta, Piramal Pharma and Kim's on your radar?
Well, yes, Piramal Pharma has announced that there's going to be a $90 million investment committed to expanding 2 US facilities. The expansion aligns with the growing US customer demand and onshoring of drug supply. Separately, the US FDA inspected the company's Turbhe facility in Feb, and now they've received a voluntary action indicated report along in the EIR, so that's definitely a positive for Piramal. Kim's numbers look good. 796 odd crores is what they did in terms of the revenue. Margins were at 24.8% and profit at around 102 crores. So Kim's didn't do too badly in terms of the quarter. For FY25 also, they closed with a growth of 21%, margins at 25%, and a profit at around 382 odd crores. So looking good for Kim's.
Okay, all right, Ekta, thanks a lot for that. Well, let's hop across to Nimesh. He's back on the ball. Nimesh, Paytm and KFinTech, you gave us a sneak peek. You're expecting something out there? Hang on.
Yeah. So, Nigel, it looks like the block season is back. There are 2 large blocks today and 1 OFS as well. The first one is KFinTech, large block. 10% is what General Atlantic is looking to sell via block deal in KFinTech. Again, they've upsized the book today morning, so it looks like the demand is quite strong. It has an 8% discount to yesterday's closing price in terms of pricing for the block. So nearly 1750 crore is the size, and General Atlantic is looking to sell 10% in KFinTech. So that's one large block. The second big block is going to be Paytm, and Financial is looking to sell 4% stake in Paytm via block deal. The indicative price is around 6% discount to yesterday's closing price. There, I believe the demand is not that strong, so maybe the deal may happen at the lower end of the indicative price. So that's something to watch out for. After the block deal, Ant will still own close to 6% stake. So they're owning over 9%. They're selling 4%. So 5-6% they'll still be left with. And there is a bit of cool off as well for the further blocks. So two large blocks, Paytm and KFintech. I believe there is a larger demand in KFintech compared to Paytm in today's block deal.
All right, Nimish, thank you very much for that. Well, let's just quickly recap what's the stocks that we put out for you. And there are lots of them. Hindalco, there's Pharma, Tata Steel, Chalet Hotels, Ventive Hospitality, Kim's, Piramal Pharma stocks in the green. There are three names in the red. There's Happiest Minds, Paytm and KFintech, two of them, of course, with regards to blocks. So that's the picture. What's happening as far as commodities are concerned? I think industrial metals rallied yesterday. Gold, oil prices are higher. Gold is lower, so a fair bit of movement all around. Manisha, good morning.
Oh, well, absolutely, Prashant. A couple of things that the markets are still reacting to. One, of course, as we've been talking about, the US and China temporary agreement to lower tariffs for 90 days. And that impact clearly has been seen for the dollar index, which is trading at a one-month high, above 101.5 at this point, absolutely weighing and putting pressure on the gold prices, which fell 3% yesterday and are just about holding $3,200 an ounce in the Asian markets now. Crude oil prices, after gaining yesterday, have eased from those two-week highs as the markets now focus at OPEC and allies, which are increasing production for the month of May and June as well. But yes, one sector which has continued to gain for a second straight day today has been the industrial metals. Copper gained 1% overnight and is trading above 9,500 right now as well. Aluminum is trading at a one-month highs above 2,500. Zinc is trading at a 5-week highs right now. So across metals, we're looking at strong gains here. And because US and China are quite strong when it comes to agriculture commodities as well, and that trade might rebound and regain, we're looking at soybean trading at Feb highs, cotton at a 3-week highs, corn prices off from 2-month lows as well. So most of these commodities where China trades are doing quite well.
Okay, indeed, that China trade is on. Manisha, thank you very much for getting us the latest. We'll take a quick break on that note. Come back on the other side. We'll have Amnish Agarwal of PL Capital joining in. We'll discuss some fundamental stock ideas for the day. Welcome back. You're with us on Bazaar Morning Call. Before we get to our fundamental stock ideas of the day, let's actually go through a quick corporate conversation and look at numbers and earnings that came in from Kim's Hospital. Now, Kim's reported a strong set of numbers for the fourth quarter. The margin and revenue growth came in strong. Average revenue per patient also was up by about 9.2%. To talk about this and more, we have Bhaskar Rao, CMD at Kim's Hospital, joining in. Mr. Rao, good morning. Thanks so much for being with us. So can you give us some more details in terms of occupancy levels and what led the growth? How do you expect your, RPOB and those kind of metrics to move as we look at this year, this quarter?
So as of now, we have done in the last year very well than what we expected because of all these operational efficiency. The bed occupancy is 48%. The reasons are we have been added around 600 new beds in Nasik and Vizag. Because of that, the ramp up will be taking a little time. That the occupancy has come. Not only that, there was about 3.11 is the ALOS, that reducing of ALOS increases the operational efficiency. And also more and more complex cases when we do these RPOPs and revenue per patient has increased, and this will continue to grow. And moving forward, this year will be much better than the last year. The reasons are we have been commissioned Nasik about a couple of months back. It has been taking a very what we expected. And also Nasik, Thane we did about last month. Maybe in a couple of months it is going to be streamlined. That will also be the growth engine. And this month, in the month of June, we are planning to do the soft launch in Bangalore, 2 hospitals. Maybe
Okay.
that will take in the second quarter, will also add to the bets.
So some numbers to all this will help. If we could get, step by step, first of all, if you could give us occupancies in Q4, what was the blended occupancy, and also if you want to break it up geographically. And then let's talk about the RPOB, where you are at, and then we'll talk about with the complex surgeries, etc., where you could be perhaps in this year. But Q4, can you give us those levels first?
So the Q4, the occupancy, the bed occupancy is around 48%. The reasons are, one, the A loss has come down from 4.1 to 3.6. That is one. Second important thing is the complex cases has been increased, like heart and lung and the bone marrow transplants, and the increased number of knee replacements and other things, and the complex case of the cardiac cases. All these things has increased from 39% to 42,000 for the average revenue per bed, and also it has gone up to 135 to 141 is the RPOP.
Sorry, you said average revenue per bed is 42,000. Can you just repeat that? What is the...
Yeah, 41,000 was the average revenue per operating bed.
Okay.
And it has gone up to 141 is the revenue per patient.
141. Okay. And about 41,000 is the average revenue per bed. Now let's talk about all the new facilities that you are commissioning. At a steady state basis, what is the occupancy and also the break-even timelines for a lot of the new facilities, like you mentioned, Nasik and a couple of other places as well. Bangalore, you're saying, will start off in June. What is the total bed addition that you will do in FY26? And in how much time are you expecting the new hospitals to break even?
The hospitals of the new hospitals, usually it will take 2 to 3 quarters to come to EBITDA zero. And we are on the track of Nasik, which has started about a couple of months back. I'm sure by end of quarter 2, I think it will be EBITDA zero. And Thane has been started. Maybe it will take about Q3 or Q4. It will become positive. And in Bangalore, we are starting about 2 hospitals. These 2 hospitals will take by quarter 4, I think it will be EBITDA zero, so that there will not be any loss spending beyond that. These are all, we are very confident that the way the Nasik has been taken off, any new greenfield projects when we do, we are being the new place there. Boarding of the doctors will take little longer time. Some of them already boarded. And once these doctors keep boarding, and then the revenue and the patient occupancy will improve.
Okay. So finally, can you just give us, walk us through roughly, what is the top line growth with all these hospitals coming, the new beds that you're adding, and the share of complex surgeries also increasing? Give us some sense. What will be the top line growth for KIMS in this year? And where do you see your margins stabilizing, EBITDA margins?
See, what I believe that even previously also I was telling about the growth, what we are looking around year on year, about 25-30%, that will definitely will achieve. I am very, very confident on that.
All right.
And the margin?
Margins also will able to initially may dip down because of the next 3 quarters of the drag on the new facilities, but the existing hospitals continue to grow what it is growing, because it will add little more EBITDA to because the operational efficiency and as well as the it is all moving beyond the required occupancy. So I'm sure that EBITDA growth also will be there. Maybe if the drag is a little longer, it may come down, but ultimately it will also happens to be the same growth what we expected.
Thanks a lot for joining in, Mr. Rao. Wishing you all the best for FY26. We'll keep speaking as the year progresses. Well, let's get back to tracking stocks and talking about fundamentals of all the names that we're tracking. We have Amnish Agarwal, the Director Institutional Research at PL Capital, who joins us on the show. Hi, Amnish. Thanks a lot for joining in. Let's talk about Hindalco first up. Novelis's numbers, they indicated it's going to be an improvement. Bang on. Good improvement being seen out there because volumes improved. You had pricing as well. That's pretty okay. However, scrap pricing is going to be at an elevated level. And because of the uncertainty on the geopolitical front, that's why, in fact, the management has not given a guidance, which could be viewed a bit negatively. What's your view on Hindalco post the recent run that we've seen on the stock?
Hi, Nigel. So, this is the main thing is that in Dalco, I think, as far as your Novelis is concerned, giving a guidance is not an issue because as far as your aluminum prices are, I think, strong, the domestic operations will also continue to do well. Their capex plans, they are on track. And I think in the current scenario with firm aluminum prices, yes, Novelis on its own, because it is more like a converter, there could be, you can say, some ups and downs coming over there. But if you look in totality, I think Hindalco still continues to look quite good.
Hindalco looks good even from here on. Got it. What about Tata Steel? Numbers in line, and the management has raised this ambitious guidance about cutting costs by close to 11,500 crores in the next year. I'll speak to the management later today, but those numbers looked okay, and now things could improve from here on. Would you be a buyer at around 150 rupees?
You see, in Tata Steel, for example, this your cost cutting that is primarily in the overseas operations, like, for example, your Tata Steel Netherlands, Tata Steel UK. And given the fact that your raw material prices are slightly benign and overall your product prices are firm, so the near-term outlook for the steel stocks in general and for Tata Steel in particular looks good. But I think the major determinant here will be the cost cutting of 11,500 crores, which they are suggesting. Because if you look at the history of all the operations overseas, I think that is where they have been faltering from time to time. So if they can achieve a significant part of the cost-cutting measures which they are suggesting in the overseas operation, then I think that could provide some sort of an upside in Tata Steel for sure.
Yeah. Amnish, hi, good morning. For markets broadly, is the tone going to be a lot more constructive? Look for ideas you want to buy. You think a lot more interest will start to come back? The big cloud, of course, was much slower global growth because of US and China. And that perhaps that some of that cloud has been lifted, hopefully, at least for 90 days to begin with. What's your sense?
You see, there are two ways to look at it. First of all, as far as your global growth is concerned, there was a lot of uncertainty. If you look at past, particularly from the beginning of April or the middle of March, given the kind of, you can say, tariff wars which were likely and the uncertainty which was there. So definitely, I think one after another, many countries now, they are entering into, you can say, the trade agreements with US. And in addition, some of these countries are also entering into, say, your trade agreements, for example, India and UK. Concluded at free trade agreement. So I think all those things where your tariffs eventually on a global scale come down will be beneficial for increasing the demand on a very, very broad basis. Now, when it comes to the other part of it, you see the Indian markets, if you look, they are driven not only by the global markets, but also by on the domestic side. Now, if you look at the private final consumption expenditure, so that bottomed out in 2Q, and after that it is going up, inflation has cooled down. And now with monsoons likely to be normal, benefits of tax cut, I think slowly we will see the momentum even building up in the domestic market. So if the domestic demand picks up and we don't have any incremental problems coming on the, I would say, the borders due to any war or something, I think we are poised for a very decent year. In the coming few months, I think the markets should continue to remain quite firm from here on, because the valuations had corrected; they were not that expensive. So if the earnings catch up is there, then I think we are in a very sweet spot at the moment.
Yeah, that's the big hope that we get back our mojo with respect to earnings. Amnish, actually on that, let me ask you, that's exactly the point. We're almost winding down the season. And as always, we start with bigger expectations and we go through some downgrades. At PL, what is your estimate? What's the extent of downgrades right now? And at FY26, where are you at? Which then brings me to the broader market question. From a valuation standpoint, is there still something left on the table?
You see, the main thing is which, for example, in case of, say, FY26 or 27, I think maybe a couple of weeks down the line, I will be able to give you the firm numbers because there are some large pockets of the sector which are still left. But what I can tell you is that as of, say, your last weekend, if I look at the overall variation in the results which have been operated, surprisingly, the numbers they have been, you can say, higher than what we anticipated. For example, there's a big bet in oil and gas, but even if I remove oil and gas, the kind of pressure which was anticipated, the kind of negative vibes which are there, the numbers surprisingly have been much better than that. So the numbers, I think by maybe 2 to 4%, if my memory is right. So the numbers have been actually higher. So that gives us a lot of confidence that first of all, the probability of an incremental EPS cut happening for FY26 and 27, that looks very, very tough now.
All right, Amnish, thanks a lot for joining in and filling us in with your quick take on all the stocks we discussed. For the time being, we slip into a short break. Up next, we'll get you some technical trades. Stay with us.
Welcome back. Before we go on with stocks, let's just pause for a second and talk about what was the biggest global development yesterday. That is the US and China getting to some sort of a thaw, a point of discussion at least with this 90-day window that's been opened up. Prashant is, joining us now from the wall because he's been looking at a lot of analysis and some history as well to figure out what perhaps could lie ahead. Prashant, that's the question. I mean, yesterday the globe cheered this as the best thing ever. But it's not really done till it's done, right? This is just a 90-day talking window.
No, absolutely. And I think, markets, as they say, they're not pricing in what has happened yesterday. They're trying to see where things will be 3 months, 6 months down the line. As impossible as that may seem, but that's essentially the game as far as markets and stocks are concerned. So, we're not going to go through everything which has happened because I think it is well understood now. We're just going to look ahead. I'm going to just put up 3 sets of graphics. One is what this means for the rest of the world. The graphics will start to come up. It matters to China, it matters to US, what's done, but it also matters to the rest of the world. Chinese exporters have got now a lot of breathing space because the tariff gap between China and the rest of the world, other trading partners, has narrowed significantly. I mean, if you remember all those discussions, I mean, Chinese goods into the US are going to be charged at, say, very high, 60, 70, 145%, whereas not 145, normalized, if the terminal rate was, say, it was settled at 45%, 50%, I mean, other trading partners were looking much more competitive. That gap has narrowed now. So it gives them a lot more room to compete on global pricing. So great for Chinese goods because they get breathing space, but some of the perceived advantages that other trading partners perhaps with the US has had because of this, because of the US-China tiff, perhaps, it starts to maybe we'll have to reprice those expectations in many areas. Now, the other question is, are there any U-turns which we should expect, or will these announcements stick? Now, here there are 2 points. It'll basically depend on how well Trump is able to sell it to his voter base in the US, right? I mean, this is the Republicans, this is the Make America Great Again base. And he's sort of berated China as being unfair and how he's going to make America great again by not allowing China to do all of this. And the other point is, if you went through the joint statement, the press conferences, etc., China doesn't look like has really put any big new commitments on the table in terms of what they are going to do, in lieu of which they've essentially now, their tariffs have been brought down to 30%. At least we've not seen anything being announced publicly. So that's the political risk I'm talking about. And this comes from Trump's home base in the US. I'm not saying if he's not able to sell it, these tariffs will go back up. But the point is, what happened yesterday was a starting point. And now much tougher negotiations will happen. And if Trump, the narrative takes hold that he's given in too much, he's blinked first, I mean, the next round could be much tougher. In that sense, right? I mean, so that's the political aspect of it. Now, then there is history, which is the last part which I want to put out. And history, of course, is always cautions us. Back in 2018, this was in December, I think, during Trump's first term, when he was president the first time around, US and China had agreed to a 90-day suspension of tariffs, just like now. The 90-day passed, the deadline was extended after the expiry of the pause. And guess what happened? The dispute escalated between US and China. It did not go down. So these are what are we, this is what are we sort of, looking ahead into in terms of things which may, as you called it, twists and turns, which we, I think, should be cognizant of, unlikely to be smooth in such a volatile kind of a environment. So just sort of thought we'll put some of this up for our viewers. Nigel.
Well, thanks a lot for that, Prashant. Rather interesting piece. Let's see how that unfolds. For the time being, as promised, let's get in our technical experts. We have Sudarshan Sikani and Chandan Taparia who join in. Good morning, gentlemen, and good to see you all in as always. Sudarshan, you go first. We're getting a dip of around 140, 150 points early this morning after a super run that we saw. Buy the dip?
Yeah, good morning. Yes, buy the dip, but not necessarily in the morning, because we have to see at what point the market stops falling. And if that doesn't become visible, then the levels should be somewhere around 24,650 approximately. That's the zone in which buying would be suggested. So be ready to buy the dip. Just be patient and see when the dip is giving signs that, okay, this is probably the end of the decline.
Okay, got it. Buy the dip, but not necessarily in the morning. Sudarshan, what is the level we should be watching out on the downside? If we breach that, then you will give up this bullish bias that you've had from early on 24,000.
Nigel, the levels are not there. That will be 24,000. So I think we'll have to maintain a bullish bias irrespective. Somewhere around 24,650 we buy. That's it.
All right, Sudarshan, I recall when the markets were also jittery, you had recommended to buy, and it's given good returns from that 24,000 mark itself. So good going on that. Let's get in Chandan Taparia this morning. Hi, Chandan. Good morning. Good to see you win. What's your trade on the Nifty?
Good morning, Nigel. Thanks for having me. So we have seen a decent run-up of more than 900 points in Nifty. It gave the breakout about 24,555 marks, which is a 61.8% retracement of the entire decline from 26,277 to 21,743 marks. So I believe that till Nifty holds about 24,555, ongoing momentum could continue and declines could be bought for the final target towards 25,200 to 25,500. So I'll continue to be with bullish stance. Market has seen the really strong bullish grip. The India VIX fell down by more than 15-20%. I believe VIX can go down below 16-17. So till it holds about 24,550, I believe buy on decline could continue in the Nifty index.
Okay, all right, gentlemen, we'll want to hear from you all in terms of, what are your stock picks as well. So request you to stay with us. We'll slip in a short break. We'll come back. We'll get you pre-open rates. We'll get, the picks from our technical experts. And also we have the Macquarie analyst as well as an industry expert to join in to weigh in on the pharma sector. Don't go anywhere.
Okay, welcome back. Sudarshan and Chandan are with us. Gentlemen, morning. Let's get the stock ideas going. Sudarshan, what do you have?
Well, I have Indigo as a buy. It's an all buy list. That's what we should be doing. Indigo is a buy to stop under 53.70. NBCC is another buying opportunity. Buy under 97 with a stop under 97. Wipro, which is coming out of a very long trading range, is looking interesting as a buying idea. Stop under 252. And finally, we'll take a chance and buy Sun Pharma. Yesterday, Sun Pharma had a big decline and then recovered all its losses. So let's see what happens. So Sun Pharma is a buy with a stop under 1655.
Okay, got that. Chandan, what about you?
So first, I will be buy on LTI Mindtree. We have seen a decent bottom out approach in most of the IT counter. The Nifty IT witnessed a rally of more than 3-4% during the day, led by short covering and support-based buying. So LTI Mindtree will be the first trade. The stock has given a breakout from its rounding bottom on the weekly chart, a rough head and shoulder on the daily chart, which has bullish implication. It has given a consolidation breakout of last 45 days, holding well above 50-day exponential moving average. Short covering trigger is also visible, so that's why I'm recommending to buy with support of 48.25 for an upside target towards 5100 zone. Second trading idea, that is buy on LNT. The stock started to form higher top, higher bottom on the weekly chart, surpasses falling supply trend line. Bullish bias is clearly visible, led by coal unwinding and the put writing position. So one can buy with support of 35.25 for an upside target towards 37.50 marks. Last trading idea, that is buy on SDFC Life. The stock has been moving upwards with the support of rising trend line, holding well above its key moving averages. On weekly chart, it has formed a narrow range price pattern, which clearly indicates that a small follow-up could lead to the fresh breakout. And stock has behavior of moving upwards and then consolidation and then fresh leg of rally. So expecting a run up towards 770, one can buy with support of 720 marks in SDFC Life.
Look at the rupee, which is coming through. Jandan, thank you very much for that. Sudarshan, thank you very much for that as well. 84.62 is where the currency is now opening at. And this is, of course, I mean, the dollar, which has seen a big bump. 85.37 was... why are we putting out Friday's close? Okay, rupee market was closed yesterday, beg your pardon. Forex market, actually lots of markets, Forex markets were closed yesterday. 85.37. So there's all that adjustment has to take place now. 84.62, which has happened, in terms of the significant announcement, so much stronger on the currency as compared to the dollar. Well, let's put the spotlight on the pharma space now. The Trump administration has ordered drug companies to voluntarily cut prices of their drugs or face regulatory actions. The aim here is to align US drug prices with peer countries. We discussed how this will impact Indian pharma. So this has been going on for the last 2 days. Pharma stocks sold off on Friday in the US. And last night, of course, there was an executive order which was signed. It looked like perhaps it's a little better than what was expectation. And some of the innovator companies in the US actually were slightly higher. We have Anaswamy Vaidish, former managing director at GSK Pharmaceuticals. Sir, good morning. Good to have you with us here. Prashant this side. Could you give us a sense on, everything we've seen? Is this going to really impact Indian generic pharma companies? And I think at the heart of that question is the point that many have made, which is that there is very little room for Indian generic pharma prices to go south from here. Your sense, sir?
Good morning, Prashant. Thanks for having me. See, first and foremost, this particular issue came up even in April 2020, if I'm not mistaken. I think it went through the whole hoop, and then due to some legal condition, it got shelved again. Now, as far as this particular point that is being raised again is focusing on the Part B of a Medicare spending, which is approximately, it's a medical insurance, 310 billion. And to some extent, Part B, which is a prescription drug, which is 130 billion. Largely, they're all related to innovative drugs. Basically, the drugs which are in patent, like, for example, Keytruda and weight loss drugs and all those, primarily the companies in U.S. companies. As far as the generic, the branded, the non-branded generics, the comparative pricing compared to the other OECD country versus U.S., it's not that significant. So I think, in fact, U.S. prices are relatively lesser, if I'm not mistaken. Some expert could do that. But based on my understanding, the non-branded generic prices are already lower. So, frankly, in my opinion, for Indian companies, the people who are selling generic drugs, I'm not sure how it's going to have an impact. Of course, more detailed work needs to be done. Largely, it concerns the innovative drug companies. That's where I stand right now. Please go ahead.
Right. Mr. Vaidish, thank you very much for that, sir. I think it sets the context for our next guest who's now with us. Thank you for joining us, and we'll have you back on camera in greater detail. We have Kunal Dhamesha, Pharma and Healthcare Research Analyst at Macquarie Capital, also with us. Kunal, good morning. Prashant this side. You heard Mr. Vaidish there. Would you broadly agree with it that the fears around Indian pharma is unfounded? That's kind of the base case, although prices have been reacting here. I mean, Indian pharma generic companies, stock prices have been reacting. But generally, the base case, from what I understand, is that impact should not be all that great. So weigh in on that. And are there any risks? Are there any way that Indian generic companies can lose because of what has happened? Go on.
Sure. Good morning. So the way I would put it is the final executive order, which we saw yesterday evening from the US president, it's a much diluted version of what he had put out in September 2020, which, as Mr. Vaidish said, eventually faced legal challenges and was withdrawn by the Biden administration. But the yesterday's version was much more diluted in a way that, the focus is on patients who directly want to buy drugs from manufacturers. They will get the drugs at the most favored nation pricing, right? Versus that the earlier version was that the government will set top 50 drugs in Medicare Part D, Part B as a target segment. Versus that now the discussion has moved to the patients who actually directly wants to buy. Now, if we look at this patient population segment, it's only 8% of the US population which is currently not covered by any health insurance. And hence, those 8% people will only be using this channel to buy drugs at a lower prices. But the other channel, the earlier version, which had said Medicare or the government buying will get impacted, that is not there in this executive order. And hence, this one is a much more benign executive order without having much impact on any of the companies, whether it's branded or generic company.
Kunal, hi, morning. I was going through your note, which interestingly points out that on average, I think US drug prices are 2 to 5 times higher than other comparative countries, right? Because they're saying we are comparing with other developed countries and seeing where prices are, and our prices should be as low as the lowest country. So a two-part question. There are Indian generic manufacturers. What happens to them? Because if the original drug price has to come down so much, then wouldn't the corresponding generic price also have to come down? And then there are the specialty product makers like Sun Pharma, and we saw the pressure on Sun stock yesterday. So what happens to them?
Yeah, so I'll take up Sun Pharma first because they have a direct branded exposure in US, and they have roughly around 20% of their revenue coming from this branded drug business, which is called specialty business. Now, within that, everyone has their own estimate, but almost 80-90% of that revenue comes from US. The company doesn't disclose it. Now, within that, the biggest product is Illumia, which in my view has some form of Medicare exposure, which is higher than the usual drug would have. And in that case, that is why, when the social post came in from the US president, the stock was down. But I think with looking at the exact details of the executive order, I think the stock will recover today because, as I said, the impact is much more benign. It's just for the 8% of population which doesn't have insurance. The pricing would remain same for anyone who is buying drugs through either commercial insurance or through Medicare or through Medicaid.
Kunal, this most favored nation, very simply, actually, it was mostly for me. Could you explain what is that channel? What you're talking about? I mean, just in the context of pharma. How would it work? Yeah, what's been done? Sorry, go on.
So most favored nation is a pricing framework, right? So in a Trump 1.0, they came up with a pricing framework saying that why are we paying higher prices versus the other developed countries? So let us benchmark that and we will pay the lowest price that any other developed country with a similar GDP per capita is paying. Right? And at that point in time, the channel that they targeted was Medicare Part B, that this is where the top 50 drugs, we will kind of benchmark the prices of this drug and we will lower the prices of these drugs in US using this framework or the benchmark pricing, right? Now, what they are saying is there's no mention of Medicare or Medicaid, which are basically where the government of US is buyer, either the federal government or a state government. There is no mention of those channels. The only mention is that patient who wants to buy the drug directly from manufacturer, they will be able to buy at MFN pricing. Which would
this is important. You're saying the reason why this would not be a big blow is that as of now, there's no clarity that drugs being procured under Medicaid or Medicare, they will also have to come at these lower prices. That's a huge relief, right? Because that's the bulk purchasing of drugs by the US government. Just to complete the wheel here, the other part of my question was, so Sun Pharma, you're saying, is likely to recover. The other part of my question was that generic companies, now even for the population that is buying through the insurance channels or buying directly, not through Medicare or Medicaid, now for those drugs, if the prices are going to be lowered dramatically, then their generic equivalents, won't there be pressure on the generic medicines?
No, generic, typically the first so I would say the generic prices would still be lower than any branded drug, even after the benchmarking, right? Because generic drugs typically when the first generic enters into the US market, it enters at around 20 to 30% price discount to a branded alternative.
No, sorry, my bad. I didn't frame it properly. What I was trying to ask was that now the actual drug price itself is going to come down in a big way. Then why should someone look at generic? Will there be enough price differential? Will it not, in some small way, kill the generics market?
No, so the average price decline that the executive order mentions is around 59%, right? So basically $100 drug would be available at 40. When we look at generic, when there are more than, let's say, 5 generics in the US market, the typical price discount would be 85%. So $100 drug would be available at $15. This is as per the US FDA data.
Got it.
Just last question, Kunal, we're running into market open. Your top ideas, I mean, just the names. I don't have time for explanation, but we'll love to have you back again. Go on.
Yeah, so I have coverage on hospital sector, CDMO sector, and pharmaceutical sector. Within these three, I'm preferring CDMO sector the most at the moment, given the entire China plus one tailwind. The loss of Wuxis of the world would be the gains of Indian CDMOs, and hence it would be the fastest growing sector, followed by pharmaceutical sector, where there are a lot of negatives which are already priced into the current stock prices. And then hospital, I remain cautious given a significant expansion coming over the next 3 years in the industry.
All right. Thank you very much, Kunal. It's a pleasure. Appreciate your time here on CNBC-TV18. And as I said, would love to have you back on for a more exhaustive discussion. But I think we got the gist of what the points that you're making, and very helpful, really. So keep an eye on the pharma space, stocks like Sun, etc., which Kunal really pointed out as a standalone name. Let's get the 9-10 calls out of the way. Sudarshan is here. Sudarshan, what do you have?
Wipro, consider buying Wipro with a stop under 252.
Wipro with a stop under 252. Thanks very much for that, Sudarshan. We'll speak again later. Nimesh is here with the standout brokerage notes. Nimesh.
Hi, Prashant. Actually, I'm highlighting a few reports which stood out for me today. Couple of names. The first one is Reliance. Citi has put out a note. They have a buy rating with a target price of 1585. And Citi sees a couple of near-term triggers for Reliance to outperform. So one of the reason is the O2C improvement, driven by higher refining margins. So that's going to be a big trigger for Reliance, at least in the near term. And the second is the YOY comparables in Q1 FY26 will look much better because of the weak, same quarter last year. So, and of course, the AGM would be an interesting thing to watch out for, because there is a lot of expectation that there could be some clarity with regards to the Geo listing. So, at least in the near term, Citi sees a couple of positive triggers to watch out for, and that could lead to an outperformance in Reliance stock. So, that's the first interesting report to watch out for. The second one is CLSA on Tech Mahindra. Today, they have upgraded the stock to high conviction outperform, and they've written a target price of 1976. So, a potential further upside on Tech Mahindra. CLSA believes that the company's vision of a 3-year turnaround plan seems to be adhered to in FY25, and they expect that the targets been set for FY27 is quite achievable. So that's the reason why they've upgraded Tech Mahindra to high conviction outperform. And the last is on IFL Finance. HSBC has today upgraded the stock to a buy, and they've sharply raised the target price to 550 now from 380 earlier. And they believe that lower interest cost, a bit of improvement or recovery in the MFI business, and lower cost of funds will mean that there could be an EPS upgrade for IFL Finance. So there is an upgrade from HSBC on IFL as well.
All right, absolutely. We'll keep an eye on all these names. Nimesh, thanks very much. Right on cue, market opening. It's a flat start, right? I mean, it's not a 100-point lower start. It's a flat start. And I think the GIFT Nifty had calibrated that by the time we ended. So 8 points lower on the Nifty. The sensex is down a little bit. Maybe, nothing actually. It's flattish. The broader market is starting much better. Mid-cap index is up about 0.2%. I think the small-cap index is also higher. It should come up. And, Sun, I can spot. Actually, Pharma is a pack. Sun is up 4%. So it's basically reversed. Yesterday's 4%. By 3:30, there was a 4% cut. Intraday was down a lot more. But it's recovering the closing losses from yesterday. It's a good start. It's not a bad start at all. Remember, yesterday you had a 3.5% pop on the Nifty. So after that, to start with an 18-20 point bump up is not bad at all. The Nifty heat map, 20-odd names lower, but the bulk of it is starting up in the green, and I see a lot of Pharma up there as part of it. Surabhi.
Okay, let's quickly get to individual stocks and then see what's moving and what's working here on the Nifty. On the upside, Pharma, the stock that we were just discussing, and very nicely explained by the Macquarie analyst Kunal there, that they're a specialty products company, branded generics is not so much their domain. And for specialty makers, the product makers shouldn't be too much of a concern. Apart from Sun, Tech Mahindra, IndusInd Bank, BEL, these are some of the gainers. Actually, most of Pharma is recovering, even Dr. Reddy's, Cipla. The explanation is simple. The order right now is not hitting the drugs that are purchased under Medicare and Medicaid. So therefore, Indian pharma companies, perhaps for now, don't have much to worry. Okay, beyond this, Reliance, Lever, these are some of the larger names that are seeing some buying traction. On the upside, Tata Motors up about 0.5%. That's the gainers list. On the losing side, Hindalco is down about 1%. Infosys, Wipro, HCL Tech is cooling off after yesterday's mega rush, as is a name like Eternal. Eternal also had a very good day yesterday. So that's slightly lower. Let's just check on Tata Steel after numbers. Very flat. Numbers were in line. Stock is flat for the time being. Nigel.
Well, let's focus on a couple of big volume movers. KFin, I think there was a block trade that needed to take place. So that stock is down 6.5%. Paytm as well down closer to around 3.5%. Paytm actually has come off the lows of the day. Swiggy, after seeing a big rally, that's come in for a sharp cut. It's down closer to around 6% as we speak. UPL came out with its set of numbers yesterday, and in fact, it appears it's coming for some profit taking. It's down closer to around 3.5%. What's doing well? JM Financial up close to around 8.5%. Big up move is what we're seeing out there. IFL Finance up 4.5%. Sun Pharma, I think you've already spotted, so that stock is up. RBL Bank, well, that's the other big mover in today's trading session on high volumes as well. So the breadth of the market is firmly in favor of the number of stocks advancing. You like that? A few more stocks actually that are coming on your radar. Care, that's up close to around 6%. Big up move is what we're seeing, close to around 1 lakh shares traded out there. Ventive Hospitality, well, that's up close to around 5%. So good move is what we're seeing. Senco, well, the stock is in a 5% band, but that as well has opened up well in the green. So good going out there. The Nifty, though, now is down close to around 45 points or thereabouts. The breadth of the market is something that's now narrowing a little bit. From around 1,700 stocks advancing, it's come down to around 1,380. Par for the course, one would have to say.
Absolutely. And it's 24,870-ish or so. Just to, if you can pull up Swiggy, our colleague Shilpa yesterday reported that Zepto is seeing another round of fundraise, another round of large fundraise. So that's an unlisted competitor. But Zepto, of course, is the player which has been keeping the heat in terms of what the listed players and everyone can do in terms of prices. And so will we see another round by well-funded Zepto now with more money in the bank in terms of pricing strategies, etc. So Swiggy is the one which is down 7. Eternal, Eternal is down about 1%, but that's not down sharply. So there is that. What else? JM Financial is up 9%. JM Financial is the third largest volume-led gainer right now. It never shows up in the top 10, top 15 gainers list with this kind of volume. 4 million shares, by the way, on JM Financial coming through.
This is result reaction. Results, and especially the bottom line look quite good.
IIFL, Nimesh was talking about. IIFL is back above 400. I think after a while, should be after a while, but it is. And there's that HSBC upgrade, which Nimesh pointed out, is the second largest volume-led gainer. And of course, Sun remains at number 1 in terms of volume-led gains. Zentech is up 2%. Zentech back above 1,500 now. 2 days, 10% gains on this one. And there is a lot of pharma stocks which are moving around. And I think the Nifty Pharma should be able to quickly give you a sense of how much interest there is. Oro and etc. So they're all doing pretty well. On the downside with volumes, there is the block stocks, which is KFintech, Paytm, etc. Swiggy, I think we've already mentioned. UPL is down. Some of these chemical names, right? So UPL is down 3.5%, and it's got volumes on it, by the way. So keep an eye on this one. The other one is SRF. SRF is down about 2.5%. Both have got decent volumes for this point in the day. So again, something to keep note of, keep track of. At this stage.
Just one more thing on Swiggy. In December, the stock hit a high of 617.
Yeah.
So from the peak, it's actually halved after seeing such a big run. And last week, actually, there were a particular number of shares that got free for trading as well. So the lock-in period has ended. So I think that's what's weighing on the stock. Down closer on 7%, 617 to sub 300 rupees. Difficult times.
Yeah, absolutely. Even some of the guys who gotten the pre-IPO round, etc.
325.
I think there would be pressure there now. Well, let's welcome in Shreyas Devalkar, who's with us now, head of equity at Axis Mutual Fund. Shreyas, good morning. Good to have you with us here. Thanks for your time. As a local money manager, Shreyas, what is your sense and what is your team's sense on what markets are likely to do from here? How much does the cloud of US-China full-blown trade war lifting a little bit, clearing a little bit, help equities, help us get a bit of a lift? So let's just start with that and then we'll get into what you like, don't like, etc. Go on.
Sure. There are two, three things happening actually around. One is obviously the de-escalation of conflict between India and Pakistan. And that is obviously one of the key measure and because of which obviously the market has also gone up in last few days. Especially on your question of your China and the negotiations there. So with US-China agreement to reduce tariff almost for now 90 days, and that reciprocal tariffs are now the history. So with that, the focus at least will shift to how the global growth will shape up. So the uncertainty in decision, which was actually hurting most of the sectors, most of the global capex cycle and global growth cycle, with this they coming to a conclusion probably over the next 90 days, that indecision will go away. And in our opinion, generally the drag on the global growth, which has been there around 0.5, 0.3% of that may come off. So that is a really good news. So that is first time thing to start with, and whatever exporting companies out of India, that will be a positive way. That is the end clients will start taking decisions as such. Now the next step of will start with what are the real benefits to us. This China plus one trade, which companies will shift here, which companies are actually trying to set up plants in US. There are some companies which are talking about setting up plant in US. There are some companies, global companies, which are coming in India and setting up plant in India on the China plus one policy. So these two are the key thought processes for us, and we are tracking and getting into more details of all our investing company and the universe as to what exactly will shape up there. And that will chart a part of portfolio in a way forward, because the easy trade, which is, yes, the overhang on global growth is behind, or is going to be behind, if not today, but in 3 to 6 months, that probably is already in price. That what you are seeing, the sharp move in IT, etc., in yesterday's move especially.
Shreyas, hi. Thank you for joining us this morning. So let's talk about the pockets of the market that you like the most, given that things are still in a phase of transition, so to speak. Purely from an earnings and valuation perspective, earnings growth, that is, potential earning growth and valuations, where do you see maximum comfort?
True that actually when it comes to growth, if you look at the broader growth numbers are not as exciting. Obviously for India, for some time now, it's the macro which is good, has helped a lot. In that macro, especially the currency, the forex reserve, fiscal deficit, and especially the liquidity which is being infused at various point in time by RBI. That is also helping a lot. And in all this context of all these things, one need to also look at the volume growth numbers. And when you look at that, and if you go by especially the recent result season, and if you go sector by sector, then there is not much positivity on as far as the volume growths are concerned. So if you just start talking about, say, auto growth. Now in auto, the volume growth is subdued even now. In staples, it remains subdued, barring one company, or only the positive I would call out is there is no further deterioration. So that is definitely a positive. But otherwise, the growth numbers, if you take even the credit growth numbers and the deposit growth numbers, it has not deteriorated, but absolutely these numbers are not, as of now, good. So in this context of good macro and not so good bottom-up growth numbers in various key sectors of investment. Obviously, in mid and small cap, there are always some bottom-up stocks, but in the key sectors of economy, the growth numbers not being good, there goes back, the viewpoint goes back to the risk-reward framework on the relative valuation basis. And in that, now more and more, so probably last 6 months ago, we also took that call, yes, because banking as a sector has underperformed over last 6 years, and that's where the valuations are good, and then it should be the at forefront. In my opinion, now such calls will be at back burner, and you need to really get into the details of the individual sectors and companies. Now, just based on good liquidity, the entire sector, banking sector doing well, may or may not be the right thing from here on, because there also that somewhat the catch-up has already happened, and the valuations are in the context of relatively slower growth. So we are really focusing on individual stock across sectors. It may be in pharma. Pharma also has shown some correction. It may be in IT. It is in banking and lenders, especially. Lender space also looks good. But there is no particular bias towards a sector per se now.
Okay, all right. Hi, Shreyas. Good morning and good to see you in. I wanted your take on Indian hotels, the travel and tourism space. I think that was one of the stocks that you had in your portfolio. Aviation as well as travel and tourism stocks came in for some profit taking, but now the world is a better place to live in, because the border tensions have cooled off as well. And it appears geopolitical tensions on the whole are cooling off. How would you approach this theme, keeping in mind that some of these stocks have already had a very, very good run?
Right. So as far as travel and tourism as a sector is concerned, that sector has started doing well over the last 2-3 years. It's not actually today's story. And that's where obviously it is in price. But point is that whenever any stock, particularly, and not only in this sector, it can be retail or it can be in any other sector, whenever it is a high valuation, we give importance to certain other aspects of the industry structure per se. The aspect of industry structures are how is the market share, how the market share is growing, how whether there is a monopoly, duopoly kind of situation. Because if market structure is in your favor, then the business cycles you can bear with. One can trim the position somewhere here and there, which is okay based on the small short term because of maybe the war-like situation, and it could have been there could have been some impact on the earnings of some of these names, but over a period of time, if the market shares are growing and companies are showing that and the industry structure is evolving in their favor, I think that is the key criteria for long-term investment. While near-term and short-term calls one may take based on the near-term numbers.
Okay, all right. No, absolutely. And I think, some of this stuff really interesting and good to track. By the way, Shreyas, the market has taken a bit of a dip, and maybe I can just quickly mention it. 160 points down now. So we're at the, I should say, 15-minute low, because that's how long we've been trading. That's it. Market breadth, 1450 stocks are higher and about 900 stocks are lower at this point in time. There are some new additions as well. Top of the volume board, Redington was not there. Redington is up about 6%. Stocks at about 276 right now. There is Sagility, which I saw in the right at start. It had gains, but it's got large volumes on it now as well. Sagility is up about 5%. Birla Corp, we'll have the management with us in just a bit. 6% gains there, 1350 or so. There is India Glycols, there is EPAC Durables, Godfrey Phillips is up about 3.5-4%, decent sized volumes. There is KPI Green, which is up about 3% or so. So this is a pretty decent looking screen, in terms of broader markets and broader stocks, even as the Nifty is down a little bit. By a little bit, I mean about 0.75%. or so. So that's the picture which is emerging for now. On the downside as well, there are names and there are volumes as well. So it's not, it's a well-traded session right out of the gates for now. Surabhi.
Yeah. So from the peak of yesterday, we've given off about 200 odd points. Let's see. Nifty's lower, mid-cap still seeing individual level buying. Shreyas, thank you very much for being with us and taking us through the market opening and your perspective today. Really appreciated. Let's move on to our next corporate conversation. And Ather Energy is the next company on our radar. Ather, of course, started its listed market journey very, very recently. The numbers for the fourth quarter are steady. In fact, the losses have been narrowing. The losses come down to 234 crore rupees. The revenue is up by 29% and volumes have also been looking strong. To talk about the trends going forward, we have with us Tarun Mehta, co-founder and CEO and executive director at the company. Tarun, great to have you on. Thanks very much. I'm just recapping the full year numbers as well for our viewers to have the perspective, because even at a full year basis, I mean, the performance has improved. The losses have come down. The losses are down to about, I think, 800 odd crores for the full year, versus over 1,000 crores in the previous year, FY24. So what's the trajectory ahead, Tarun? Tell us, I mean, these break-even timelines, obviously people are watching carefully, but it's also a very competitive market when it comes to EVs, right? There's a hot competition. There are incumbents who've started an EV portfolio. Then there are, your immediate rivals like Ola. So just take us through what this year looks like for you and how are you moving on the break-even trajectory?
Right. Thank you for having me here. So fourth quarter was an important quarter for us. Overall, FY25 was a pretty pivotal year for us. Our portfolio expanded quite significantly with the introduction of our family scooter Rista. And that's made a pretty massive contribution to our business. It's now accounting for the majority of our sales already. On the back of that, while revenue grew 29%, units sold actually went up almost 42% for the year. So a pretty important year overall. What really worked out well for us is the way we have positioned our product, the overall premium positioning, and our ability to sell software on top of the vehicle. Both of these contributed really favorably. Our gross margins, adjusted gross margins, were up almost 1,000 bips. So they almost doubled from 9% to 19% in this financial year. And that doubling of gross margin has contributed quite immensely to the narrowing of losses.
So can you tell us about the future trajectory as well? I mean, at the PAT level, the net level, and also at the EBITDA level, when do you see black? And also in the quarter gone by, there was an increase in your expenses. Not sure what led to that, whether that was one of, there was almost a 48% jump in expenses. So just going back to the same question on profitability, tell us more.
Right. Expenses compared to the same quarter last year would have gone up, but that was more than offset by the increase in gross margins earned. So as the business scale is increasing and as we're expanding pan-India, some of the expenses are bound to go up, but they're going up significantly slower compared to the scale of revenue and margin growth. And I think both are very crucial to watch for us. So as this happens, there is a narrowing of EBITDA and PAT losses. In our case also, the journey from EBITDA to PAT is not very high because we are a relatively more CapEx lighter business. What's ahead for us? Gross margin trend, very favorable. There is a transition to lithium iron phosphate LFP battery packs that's underway as we speak. And there is a transition to a lower cost scooter platform, the EL scooter platform that we've already guided for in the coming time. Both of these will help immensely for our cost structures. Also remember, our margins are without PLI and the overall subsidy support has come down quite a lot. So in some sense, these margins are now fairly resilient, unlike in the previous years.
Okay. Got it. Tarun, I will come back to questions on when you go into black. In a bit, good morning, Prashant here. Could you give us a sense when you said, you started by saying you focus on the premium end, but now you're going into sort of, slightly more, not at the lower end, but more affordable scooters as well. Could you define in the EV space and scooters, how do you define premium? What is affordable? What percentage of how will this move going forward? Just some sense.
Yeah. So, see, the overall two-wheeler trajectory has been that of premiumization. If you see our scooter industry, the share of 125cc scooters has been rising steadily. They've gone from 19-20% of our industry to almost 50% of our industry in the last few years. And that's the wave that we are trying to ride. So early on, and we started at one end and we are moving more and more mainstream. Early on, let's say a few years back, our products were priced, the lowest products were in the 1.4, 1.5 lakh rupee range. About a year and a half, 2 years ago, they came down to about 1.3 lakhs. Last year with Aetherista, they came down to 1.1 lakh rupees. So we've come pretty close to the 1 lakh rupee barrier. We're not right now looking at going meaningfully below that barrier because we believe that does not augur well for profitability, nor is the customer headed there. Overall, in our industry, I would say the premium end is basically 1 lakh plus, and the ultra end of this is 1.4, 1.5 lakh plus.
Yeah. Okay. So then the question is simply this: how many more scooters will you sell in FY26 as compared to FY25 in terms of volumes? If you can give us a number, and will you what needs to change? Because there's a long runway for adoption. EVs are the future. I mean, I think all that is well understood, but you need like a aha moment for it to really pick up in a big way, right? Not just for you, but for the industry. And what will that be? You're saying you don't want to go down much below that 1 lakh price barrier. You're close to it now. What will that be? But start with the volume question, Tarun, if you will.
So honestly, we are in the midst of what I believe is the fastest growing category anyways. Even the sub 1 lakh rupee category saw a lot of volume spike last year, but you will see in the last few quarters, most people are trying to move away from it because profitability there remains extremely, extremely weak. And the larger Indian consumers anyways migrating upwards. So that's a 110 to 125cc transition. I believe the majority of our industry will be more than a lakh, is probably already more than a lakh. We'll wait for formal industry numbers in the next few months. We grew 42% in FY25. And remember that happened with Ather.
Tarun, the reason, the context is two-wheeler sales, even ICE, right? I mean, they're struggling. If you look at overall industry, I mean, just look at last month's sales of players like Hero, etc. I mean, they're sharply lower. So while yes, I mean the premium, and then you get to one step away, EV scooter. So hence the question. Go on, Tarun.
Yeah, no, actually, EV is all about cannibalizing ICE first. So EV is on a fast. EV is actually the real growth area in ICE, anyways. So while the two-wheeler industry grows at its own pace, EV is going to see a growth many times higher, and that's what it is seeing even now. Premium remains the fastest place to grow in. For us, we believe FY26 will be a higher growth year than FY25, fundamentally because our distribution is growing in this year. Last year, in December, we had 260 stores. We've added 80 stores in Q4. And we believe that pace can continue for the next few quarters because our peers are already hovering around 700-800 stores. So the big upside for us, almost uniquely this year, is that of distribution that we can now play on because we got the right products. So we are extremely bullish on distribution-driven growth in FY26 because it's the lever that we haven't exercised yet.
Hi, Tarun. Good morning. I count myself lucky this morning. And I'll tell you why. I'm getting to speak to you thrice in the last 1 month. So I'm going to push you for a couple of numbers this time around, Tarun. As you said, you grew phenomenally last year, 42% growth in terms of volumes. But your market share still held at around 11.4%. That's more or less stable on a year-on-year basis. Given the tailwinds that you're talking about, and given that you're saying that volumes are going to spurt even this year, what is the targeted market share? In the past, you've told us that in South, you're doing quite well. In Gujarat, that market, in fact, your market share had gone up as well. Yeah. For on the whole, from this 11.5%, where do you intend to head to end the year at? Please go ahead.
So you must see the trajectory. While the full year volume came out at 11.4, we began year at about 7.4, and we ended the year at about 13.3 with a consistent growth for all quarters. And that's the trajectory that we're excited about. In fact, if you see the month of April, the Vahan data will show you that we were at about 14.4% market share, plus Telangana, so almost 14.8% market share. There's a continuous upward swing in market share. A lot of it is distribution-led, and that's not stopping anytime soon. What's the rightful market share for us? So I'm looking at markets where Ather has been able to crack meaningful distribution and good brand equity. That's the South Indian markets where we've gone from about 13% market share to now about 20 to 23% market share in Q4. Okay. Or it's even Western markets like Gujarat, where we've gone from 4.9% market share to almost 20% plus market share.
Tarun, you have told me this before. From 11.5%, you'll be satisfied if you end the year at around 15%. Can we take that number on board? Or more than that, since you've already, in the last quarter, as you said, I think you're at 13% ballpark. Actually, you should be more than that, right? Where do you intend to year? Give us a range. It's fine.
I believe where South India and Gujarat is, that's the right near-term target for our business. So roughly about 20% is the near-term target for our business. Let's get there. And we're going to win market by market. South India, then West, and now Central India. So Gujarat, Maharashtra, MP, Orissa, these are the big markets for us. And this is where we want to replicate the Gujarat and South India success and get to over 20% plus market share in the near term.
Okay, all right, Tarun, we'll leave it on that note. Many thanks for joining in and good luck with all of those plans. Thanks for taking up all the questions today. Markets down about 0.5% on the Nifty. So it was almost a 180-point cut, but then now it's stabilized to about a 130-point cut on the Nifty. So not too bad. And mid-caps actually are seeing a fair amount of green at this point. So looking quite okay. A little bit of a pullback after yesterday's big move.
Absolutely. And the breadth of the market is still positive. And one stock that's really caught everyone's attention the last couple of days is Birla Corp, because they delivered solid numbers. EBITDA per ton coming at the highest we've seen in 18 quarters. To find out more about the way ahead, we're joined by Mr. Aditya Sarogi, the Chief Financial Officer at the company. Hi, Mr. Sarogi. Good morning and thanks a lot for joining in here on CNBC-TV18. First of all, congratulations. The last many quarters I've been saying, Mr. Sarogi, when will things improve? This time around, it's going to be more about sustaining this kind of improvement. Now, on a base of around 18.1 million tons first, tell us for FY26, what kind of volume growth can you deliver? And also weigh in on demand. Is it as strong as expected?
Thank you, Nigel, for having me on the show. In terms of volumes, in this year, we expect the industry to grow between 6 to 8%, and I think we should also clock in that kind of a number, if not more. So that will translate into volume in terms of specific number. It will translate to anything between 19 to 19.5 million in the next financial year. And as regards demand, although it has come off from what we saw in March, but if you see on a year-on-year basis, definitely there's a healthy improvement.
Got it. Okay, all right. What about incentives for, I think the last year it was around 103 crores. For FY26, what kind of a number should we work with?
This year also it should be around those numbers only. Next year with the Kundanganj line 3 coming into operation full-fledgedly, it should improve, definitely.
All right, so it will be ballpark per 100 crores odd, right?
Yeah.
Okay, now you've specifically mentioned that realization improvement of around 7% on sequential basis is because you have exposure to North as well as East India. Right. What is your current sales mix? Because, your key focus used to be Central India. So break it up for us, Central, North, East, what is the current mix?
See, before I give you the mix, let me tell you, across the board, there was an improvement in the sale prices, although it was slightly more prominent in North and East. So even Central and West, we did see price improvement. So it's not that it was specific to only North and East.
Okay.
Now, coming to the split broadly, we are about 50% in Central, 18-19% in North, 18-19% in East, and about 13% in West.
Got it. All right. Now tell us about realization, sir. You have given us a broad split about your sales mix. How is realizations today on a blended basis? If I compare it with Q4, is it higher?
It is at similar level on a blended basis.
Okay, what does this mean then in terms of EBITDA per ton? You have clocked more than 1,000 rupees per ton. And I have to give you credit for that. I recall when you all didn't deliver a good quarter, you said you'll end the year close to around 18 million tons. And you guided that the EBITDA per ton will improve. But I don't think anyone was factoring in this sort of a number of more than 1,000 rupees. What is the range we should work with? Volumes will be there, so you'll get operating leverage. Realizations are more or less stable. And you have input costs that will cool off with, you're changing your fuel mix and various other measures at your end. EBITDA per ton guidance, broadband?
I think, Nigel, you are bang on in terms of all the factors that you have highlighted. And on top of all of this, we have got some efficiency improvement measures also, which has yielded us about 150 rupees per ton over the last couple of years. And that is continuing and that will continue to give us benefit. So definitely in terms of EBITDA per ton, the margins, so we are expecting a healthy improvement over the last financial year, although we are not putting a specific number to it.
You can be in this vicinity of Q4, maybe
No,
minus
no,
100.
no, that is not possible, Nigel, because you will appreciate Q4 is cement
Got the
is a
incentive.
cyclical industry. No, incentive is accrued every quarter. Although
Okay.
it was marginally higher at 41 crores
Yes.
compared to the run rate of 26 crores on a quarterly basis. So that's not a significant increase. It's more to do with the cyclical nature of the industry. Q4 is typically the best quarter of the year. So you can't just extrapolate it to the remaining part of the year.
Okay, so 850 to 900 rupees per ton is doable.
I'm sorry, I cannot give you a number.
Okay, you give me another number then for Mukutban. You know, you're going at a run rate, Q4 at least you did close to around 750,000. For the year, you did around 2.5 million tons. Now, don't disappoint us on this. What was the EBITDA per ton in Mukutban, sir?
Nigel, I'll tell you, instead of giving a specific number, I'll tell you with the incentives coming in, it is in fact better than some of the other units that we have, IUs we have.
Okay, all right. It's a little bit better. You know, that used to be the drag when it just got commissioned. But as you're saying, it's turned around and now, in fact, it's a booster. Final couple of questions before we let you go. Net debt in the books, it's come down. That was the cherry on the cake. What is the absolute net debt number we should work with? Because you have got 1,000 crores of capex on, you know, that's will be spent this year. So what do you end this year with in terms of net debt? And the last time around, I was, you know, quizzing you whether you have some asset monetization, some non-core assets. Any such asset will get monetized in this year, which could help you keep the debt number under check?
In terms of debt, we should probably close at a number around 3,000 crores. But in terms of debt to EBITDA, definitely we expect it to be less than 2. And that is a more relevant number insofar as Birla Corp is concerned. Because when the company is growing, you should see the debt in the context of the EBITDA that we are earning. And that is a number we track internally. In regard to the non-core assets, we do have some non-core investments which probably will be north of 600 crores. But we don't have any plans to sell them. They have been giving us good returns. So unless it is really required for business purpose, we don't intend to dispose them off as yet.
Okay, all right, Mr. Saraogi, appreciate you joining in. Congratulations on a solid quarter. You're guiding for pretty okay times going ahead as well. We look forward to chatting up with you as the year progresses.
Thank you.
For the time being, we slip in a short break. You come back, we'll get chatting with the management of Happiest Minds Technologies. Don't go anywhere.
Welcome back. We're staying with a lot of the corporate conversations coming out of the Q4 earnings season, and Happiest Minds reported a sluggish set of numbers for the quarter gone by. Wage hikes for senior level employees impacted margins. Our colleague Mangalam caught up with the company's management and started off by asking about the areas that the company will be focusing on over the next couple of quarters, specifically after the trade deal between the US and China.
I think that was positive because there was quite a bit of uncertainty which was holding customers, especially in the manufacturing, industrial, and maybe even in the healthcare space. So that was a real, positive news over the weekend. As you know, in a month and a half back, when we had our press conference, we had guided that we would do double-digit growth, and that was based on some of the transformations that we had initiated. So this gives a little bit more impetus to what we had guided. We are seeing traction in a couple of verticals, BFSI and healthcare and life sciences. As you see, the contribution from Pure Software and Aureus, both in terms of revenue and capabilities, has helped BFSI become our largest vertical and show good quarter-on-quarter growth. Healthcare and life science, again, as we announced in our press release, we're able to close 2 SOWs, cumulatively $20 million for this year, and hopefully will give us close to that revenue next quarter as well. We expect these two verticals to drive our growth, and we also are expecting manufacturing and industrial to start showing growth with the deal that's been signed with China.
All right, Venkat, your thoughts. You couldn't meet the FY25 guidance earlier. Now, what is your target for FY26 when it comes to revenues and margins?
So as far as FY25 is concerned, we had talked about 28 to 30% forecast as far as revenues in constant currency was concerned. We are at about 26%. Yes, you said that right. We have maybe a couple of percentage points below. We had already, updated markets and the media about that. As far as margins are concerned, we had said 20 to 22%. FY25, we have ended with 21.4%, well in line with that, guidance that I had given. Adjusted for that one unfortunate bad debt that we had to take in this quarter, our adjusted EBITDA would have been close to 22%. So the upper end of the guidance bracket that I'd given you. So in terms of profit, we are on course. We could do better. We should do better. But these profits are adjusted for the investments that we have made into GBS, the GBS business and the new sales business unit, that sales team that we have put in place, both of which should pull in and start contributing big time in FY26. As far as forecast for the next year is concerned, on the revenue side, yes, we are holding on to a double-digit growth. And as far as profitability is concerned, again, 20 to 22% of EBITDA is a number that we are looking at right now, and would like to try coming in within that, but also try to improve on that front.
Double-digit is a wide range. If you could specify some of the ranges that you're looking at in terms of revenue forecast, and if you could break that down into how much are you looking at it coming in organically, how much of that on account of the investments that you've made in GBS and the acquisitions that you've made earlier as well?
Look at it, we don't specify by the company and the growth because, the acquisitions were completed in the first quarter of last year. So as we go into the next year, we are going as an entire company, Happiest Minds, integrated. Aureus is very well integrated. Pure Software is integrated at the business front. SMI, which was acquired a couple of years back, is fully integrated. So we are going as an integrated whole for the next year. So it's a full force number that I'm talking about as far as revenues are concerned. In terms of GBS, today their revenue contribution is about 2% of our revenue. So if you take our numbers to be about $250 million, that's coming to about $4.7 to $5 million in terms of direct and influence revenue. We would like that to go up to $25 million over the next couple of years. That's the target because, most of the projects that we do has an impact or an element of GBS weaved into it. On the margins, it sits at the company level. Last year, when I made the guidance, was also the company level. We continue to hold on the same basis.
All right, we take that point. What about utilization? I remember, Joseph, the last time we spoke, you said that utilization increasing is one of the big levers of growth for the company. Where does that number stand, and do you have a target for FY26?
Yeah, so if you look at the utilization, it did tick slightly lower, and that was primarily because of that customer that we had to stop working, where we had the bad debt and which impacted our profitability for the quarter. We stopped work. We had ramped up in Q2 and Q3. It was almost at $1.5 million per quarter. So as you can understand, it was a significant ramp down, and that impacted our utilization. We've been launching quite a few initiatives to push this number up. Part of it is also looking at our internal people as we do our performance evaluation. And that's the reason you've seen a little bit of a tick up in attrition going up to 16.8% from 15.3%. We expect that in Q1, we will get the utilization moving back towards maybe 80 or so percent. We're comfortable with 80%, and that will be one of the levers for improvement in margins.
All right, the attrition is high, but at the same time, there were wage hikes in the fourth quarter that impacted the margins as well. So if you could give us a sense on what the wage hike target for next year is, largely would it be inflation-led, a little more than that, revenue-led? How do you calculate that?
We would like to take that as it comes, Mangalam, because right now we have planned for something which is in line with what we see from the industry. Compensation as practice is more market linked. We have to see what the others are doing. in the market, because we have to attract people from there, and we lose people to the other industry participants. So it's largely market led. Right now, we have planned on that basis.
All right, and final question. What is your current revenue contribution coming in from BFSI? You had called out looking to increase that structurally. What's your target?
So I think the current contribution that we have, around 26%, is optimal. My hope is, our expectation is that we continue growing BFSI, but others will grow at the same pace or a little faster. What we are seeing out in the market is that the BFSI segment, along with healthcare, probably is showing the more best traction and green shoots. And this is reflected in the quarter-on-quarter as well as year-on-year growth that we've shown in BFSI, even though quite a bit of it has come from the acquisitions that we made of Pure Software and Aureus. But we feel quite positive about both of these segments.
Venkat, let me try this once again before we leave. Double-digit revenue growth implies what? 10 to 12%, low teens, mid-teens? How should we look at it?
No, I would like to hold it with double-digit as of this point, Mangalam. Would like to revisit that as we come closer, because while we do make plans and we are quite upbeat given the order pipeline and seeing the numbers flowing in. You don't know that all of these skirmishes that we're seeing across in various parts of the world, the trade patterns and the disputes that you see on the business front, it all has an impact. And at a company of our size, it can mean a percentage, 2-3% here and there, because we're working across a spectrum of industries. So I would like to hold it at double digit right now. Maybe we'll come back with better numbers for you in the later half of the year.
Okay, that was Mangalam's conversation with Happiest Minds. Stocks down about 2.5% right now. The market also is kind of, keeping a little easy this morning, still about 200 lower on the Nifty. That's what we have. I'm just checking where the correction is coming in. Actually, Happiest Minds is not the only IT company which is seeing a little bit of red today. In general, and that was the best performing sector yesterday. Remember, the Nifty IT had surged about 7%. So that is a sector that's giving off this morning. So it's across the board. Infosys, HCL Tech, you've got Wipro, TCS. Most of these names are on the weaker side. But the other big watch point for the market is going to be banking. Right now, the bank Nifty is lower by about 0.5%. And a lot of the bigger names, HDFC Bank, ICICI Bank, they're all looking at a little bit of pressure, about 1 to 1.5%. So let's see. IT and banks both on the back foot, at least for the time being. And the pressure on internal is now beginning to show up. Remember, we were talking about Swiggy, where the 6-month shareholder lock-in period has ended. And it seems that there's someone out there who's probably come and decided to put the stock in the market. So 6% down on that stock. Eternal also is now looking at some pain. Eternal rallied very hard along with the rest of the market yesterday. But right now, there's profit taking about 3% lower there as well. Just very quickly checking what's the counterweight to all of this. And it's really Pharma. So to that extent, we don't have too many big heavy hitters for the large cap bulls right now. It's only Pharma that's seeing a relief move, because it's become clear now with all our conversations as well that this executive order on lower drug prices in the US is not going to be too punitive for Indian pharma companies. So that's your green island today in the market. It's Pharma all the way. And do watch for BEL. Actually, let's pull up some of the other defense stocks maybe as we do this, because BEL has shot up. Big move on BEL, almost 4% higher. Let's get the intraday chart. There's a 4% up move. Maybe we can get a Hindustan Aeronautics, the usual. Your Garden Reach and Cochin Shipyard. Let's see if it's a sector-wide move. Seems to be. And the others will come up as well. So it seems defense continues to be very much in favor with investors.
Okay, just a couple of other things, right, before we sort of slip into a break. By the way, 1,700 stocks are still higher if you can put up the advanced decline ratio up. And you got about 700 stocks which are lower. So this is the Nifty down 200, but market breadth is 2 plus in favor of advances as compared to declines, and it's good going. Tanla Solutions. I mean, actually, you've got a fairly new bunch of names occupying the leaderboard in terms of volume-led gains. Tanla is number one in 9% gains on Tanla Solutions, 537. I mentioned Reddington earlier. So that's about 5%. JM and IIFL, of course, IIFL is up to 410 bucks now, so 5.6, 5.7% there. There is Man Industries, which is up 9%. Again, I mean, it's a new one in the mix now. So 342 on Man Industries. Care Ratings, I did spot it in the morning, but it's picked up on volumes quite a bit. So 1428 on Care Ratings. It's got very large volumes, actually. Doesn't show up at this point. India Glycols, 5.5% higher. Stocks at about 1628. EPAC Durables, 5%. Aarti Drugs is up 8.5%. So 464 on Aarti Drugs at this point. And Suvain is up 7%. There is 63 Moons, which is up about 5%. I can go down, but then this is essentially the cutoff with regards to volume-led gains that you've got going at this stage. So, you know, enough and more activity on the upside in terms of the broader market, but not to say there's no volume on the downside. There is. Sudeep Shah is Head of Technicals and Derivatives Research at SBI Securities. Sudeep, good to have you back. What would you recommend viewers do now, Sudeep? Near-term price action.
Good morning, Prashant. Prashant, what I feel is that this initial knee-jerk movement in Nifty from higher levels, I feel that was quite on expected lines. Although the overall undertone now remains bullish, but we will still have that volatility before we are able to successfully cross this 25,000 mark. So overall now from here on, I feel 24,550, 24,600 will act as a strong support. And gradually we'll see the index going towards 25,000, 25,100 in the coming few sessions. From a bank Nifty perspective, that could be an index which will outperform also. So here we feel that 54,700, 54,600 zone will act as a strong support. Until we hold this zone, bank Nifty would continue its upside momentum up to 55,500, 55,700 in the coming few sessions.
Okay, got that. Sudeep, in terms of specific trades, anything comes to your mind?
Yeah, there are a couple of stocks, Prashant, that are there on our radar. The first one is Canara Bank. Now, we've seen since morning a lot of momentum has been built up into the PSU banking space. And specifically, if you see Canara Bank, which has been outperforming out of all the stocks in the last few sessions, here the stock is now sustaining above its 200-day moving average, as well as the key resistances right from the month of December 2024. So the stock is now successfully has crossed that, and now it's holding about 101, 102 levels also. So we feel that this stock could be bought with a stop loss at 101. And on the upside, we are looking at targets which is closer to 110 to 115. The second stock that is on our radar is HDFC AMC. Now, here we have seen an outperformance over the last 4-5 months. The stock was consolidating between February and April between 36, 3,700 and 4,000. We've seen a structural breakout here, and the stock is now heading towards 4,750, 4,800 in the coming few weeks. So this can be bought at the current levels around 45.30, 45.40, and on dips to 44.80. Keep a stop of 4,400, and we feel 47.50, 4800 zone could be achievable in the coming few months.
Okay, all right, Sudeep, got that. Thank you very much for the ideas for trade. We'll take a break on that note. Come back on the other side, and it's time to talk commodities. Manisha Gupta is going to join in.